afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer Tuesday afternoon webinar. Joining me today is David Burrows, our Chief Investment Strategist and Portfolio Manager and President at Barometer Capital. And we're going to talk about tech and how tech's trading today, as well as provide you with a broader global macro overview. Is tech faltering because it's the summer, or is there something more to the story? Dave will hammer that out this afternoon in our conversation. As always, we're happy to address your questions at the tail end of this call. And you can email me at phastings@barometercapital.ca or send me a message via the chat. And with that, I turn the conversation over to David Burrows. And David, I do have a furry friend who has interrupted this call because he's so excited to see you and hear all about what you have to say. So I apologize. There was a bit of ruffling at the beginning of that introduction because Max wanted a little cameo time. So anyway, over to you, Dave. Happy August. Happy middle of August, I should say.
Pam, we're always happy to have a furry friend. They're often more friendly than the rest of us. Thanks everybody for joining us today. We got a lot of stuff we're going to work through. Market's been chopping around a little bit over the last week, and we're going to see if there's any message to take away from that or not. As always, we're going to start really from the top and talk a little bit about sort of our key long-term structural themes. I think really the most important job that we have as a manager is to understand the backdrop, the structural backdrop that we're working against, to make sure that the portfolios that we are running are focused in areas of market leadership. We do not need to be in every sector. We don't need to be in every theme. People can do that by buying the S&P 500 ETF and living with all of the pluses and minuses of that, including the volatility. Just from the top, we continue to believe we're in a structural bull market in the U.S. market that started in 2013 when we exceeded the highs from the year 2000. And as always, when you come out of a long period where the market has not given returns, it's generally an unloved asset and underowned, much like it was in the early 1950s, much like it was in the early 1980s. And then as the market rallies, the hardest thing to do is to stay in your winning positions because people get so used to, systematic punch in the head every once in a while. And not to say there aren't good sized corrections like there was in 1987 or in 1991, 1994, and so on. But it's more like 4 steps forward and 1 step back. So market's been working its way higher in the U.S. since 2013. To put a kind of a point on that, this is the S&P 500. This is coming out of that range in 2013. And certainly there have been some good sized pullbacks along the way. Certainly a good one in 2014-15, a good one in 2018, a big one in 2020 as we got through the pandemic, and the market has been marching higher, confounding a lot of people since then. But realistically, that is what happens in structural bull markets. They go on way longer than you think. Now, the S&P led the world in breaking out of a long bear market. The Nasdaq itself broke out in 2016. It's been working its way higher since then. It had been in a bear market since the year 2000. And if you go further along that line, the value line geometric index, which takes into account basically all U.S. stocks unweighted, it really only broke out in a sustainable way at the end of 2020. And this can certainly go on for a long time. So we think that we're still in the middle innings, earlier to middle innings of a structural bull market in global equities. We've highlighted over the course of the year that many of the global markets, including Europe, have only just recently broke out of long periods of consolidation or correction, and this can go on for quite some time. On the rates front, we do believe that like in the late 1940s, we've been going through a trough in long-term interest rates, and it does take a long time for that to take place. It's very hard for people to get their heads around the idea that actually rates can go the other way. And it seems right now like it would be very difficult, but we did see a low of 50 basis points on the 10-year bond last year. And that was probably a generational low. On commodities, we went through a long bear market from 2008 through 2020. We think we went through a trough there, and we probably have a tailwind for many, many years in front of us with interruptions. But that, for us, is a roadmap that we start with, and then we use the tactical tools that we have to understand what market action is telling us. Is breadth improving? That means there's money getting put to work. Are more and more securities participating? Or is breadth deteriorating, telling us maybe that there is risk to some of the leadership groups? Just touching on commodities just for a second, they did peak out in 2008. We made a turn in the late part of 2020. Certainly, these are monthly bars. We've been slowly working our way higher lows pretty much monthly since then. Certainly, some areas of commodities have done better than others, but as a broad-based group, very under-owned and sort of probably underappreciated. If we take a nearer term picture, here's the S&P back to that corrective period, September, October of last year, and now full year ago. And we have just been marching our way higher in this channel ever since, touching on the low end a couple of times. You'll notice this red line is the 50-day moving average. It has held on numerous occasions as we've marched our way along, and the trajectory is higher, certainly well above the 150-day and 200-day moving average. When we move from the S&P to the Nasdaq 100, we know that the Nasdaq 100 corrected in the period between sort of February and June, and then broke out, has been sort of working its way sideways. And this may be masking a little bit what's going on underneath the surface in the Nasdaq, because certainly some of the large cap tech stocks, Apple in particular, Google would be another, have really been carrying the performance over the last few weeks. There's the TSX. TSX, strangely enough, really only broke out of a range it was in from 2014, like a year ago. And so this is more early days. And that's interesting because, of course, the TSX is more dominated by financials and basic materials than certainly the S&P, has less tech, has less healthcare. And so it's interesting that the TSX, in fact, recently has been outperforming the S&P. One day last week, we had a new relative strength high versus the S&P, meaning we've been outperforming the S&P 500. There's the equally weighted S&P 500, so taking out the market impact of the largest cap companies in the S&P, giving each company of the 500 an equal weight. We know that the average stock basically corrected from May through until the middle part of July, when finally we came out of this range. And so I think that that's something that's telling also. If we thought we were into a deteriorating market, likely this would not have come out of that range, but the average stock finally making new highs. And I think that that's certainly a positive. When we look at the internal readings that we do, looking at breadth, we highlighted last week that the NYSE breadth model has been improving. And so roughly 58% of all of the companies that trade on the NYSE are in uptrends, as defined by a point and figure chart, which is really a quantitative process for quantifying trend. And we watch very carefully because we know that there's no bear market in history that ever took place while breadth was expanding. But we have seen a little bit of sloppiness in Canada, a little bit of sloppiness in the global universe of stocks, a little bit of weakness in breadth. Our short-term indicators in general are positive. Percent of stocks trading above their 50-day moving average has been expanding. Percent of stocks with positive weekly price momentum, and the percent of stocks making new highs. So we watch these as a barometer of market health. We know that generally the weakest securities sell off first, the ones that are most vulnerable. The strongest stocks hold on the longest. So if we're all focused on the market leaders and don't recognize what's happening under the surface, it's easy to be surprised when we're all staring at an index that's market cap weighted. So let's just touch on leadership and see what's changing and what isn't. We know that since March the 23rd, 2020, which was the bottom, the leadership in the market really has been dominated by more cyclical securities. So materials, financials, energy. Tech certainly has been a great place to be, industrials and consumer discretionary. The weaklings really have been the more defensive sectors. They really haven't rallied to the same extent. Recently, utilities have acted a little bit better, but still only about 58% off the lows. Now, we touched on some of the drivers. We know the key is never to fight the Fed. We know that financial conditions have been very easy. We know that lots of people are focused on inflation and the risk of a sustained push higher in inflation. The Fed to this point has been making a case that inflation is most likely transitory. We know that they are focused on employment data, wanting to get back to full employment. But as we have been going along, they have been sort of jawboning the idea that they may start to slow down their purchases of long-term Treasury bonds and mortgage securities. That has put a tremendous amount of liquidity in the market. So we watch that. But remember, even when they start to taper, all that's doing is reducing the amount they are buying. They aren't selling them back into the market. They are not reducing the liquidity in the market. We talked last week about the fact that ISM inventory data is at multi-year lows, and that likely that will be supportive to orders over the next several months. We talked also about the fact that we have been seeing considerable earnings revisions. So 73% of companies revising, 73% of earnings revisions were to the upside in the month of July, which again is sort of a multi-year high. And we've also talked about the Treasury bond. Now, the Treasury bond, this is the 30-year Treasury bond price, has been falling really since March of last year. We got to a low in March this year, and certainly we had a bounce. You can see that it bounced with a falling 200-day moving average, of falling 150-day moving average, and we put in a recent high back in the early part of July, rallying and failing to make a new high, making a lower low, and again pushing higher, but so far unable to make a new high. When we look at a point and figure chart, which maybe gives us a little bit more information, you can see that while the price of the 30-year Treasury bond bounced, the flows into the bonds have been extraordinary, and it tends to be when we get to this level that we're getting overbought in the short run. So it shouldn't be a surprise that the bonds maybe are running out of gas a little bit here. And when we look at a point and figure chart, we can see that from August of last year, prices on the 30-year bond were falling. We bounced through April, May, June, July. And on a point and figure chart, if the rally is less than half of a long decline and then reverses down as it has recently, that looks like it's a failing rally. It's more of a retracement or a correction in a down market. So given that we have seen very extreme flows into the bonds and it produced only a cursory rally, it strikes me that it is likely we probably resume falling bond prices and rising yields. This is the 30-year yield index. You can see lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, but a shift, a rally in yield, a pullback to a higher low, and now a higher high. So it looks to us like we have probably reversed that correction, and that has implications for the sectoral work that we do. The first and most important thing that we've highlighted over the last year is when you get into potentially a rising rate regime or a reflationary regime, one of the most productive strategies is to focus on dividend growth. Companies that have had a historic ability to raise their dividend as time goes by, because we are likely to see rising share prices and a rising stream of income. Just as an example, we've used RDVY before as an ETF, which is in companies that have a history of rising dividends. This is the Vanguard Dividend Appreciation, the ETF VIG. You can see made up of Microsoft, JP Morgan, Johnson & Johnson, Walmart, Visa, United Health, Home Depot, Procter & Gamble, companies that have had a prolific ability to raise dividends. And here we are after correcting sideways while the bonds corrected, resuming the uptrend and making a new near-term high yesterday. So dividend growth clearly continues to be leadership and is clear leadership over high dividend paying stocks with lower dividend growth. The other thing that we've seen is that after correcting, the value ETF has made a new high as of yesterday, and relative price performance again starting to rise. So if our core themes have been more cyclical, value-oriented themes since October of last year, we've seen a corrective period. The market is recharged and looks to us as though these themes look to be ready to continue their leadership position. and bond prices likely to continue to weaken. And on a relative basis, when we look at a universe of 6,000 ETFs, this week there were 299 ETFs that made new relative lows versus the S&P 500. Virtually all of them, save a handful of 7 or 8, were bond or fixed income ETFs. So something to keep in mind. We certainly don't subscribe to the 60-40 portfolio, 60% stocks, 40% fixed income. We think fixed income is going to be very difficult going forward, and dividend growth is a strategy that should be used to replace it. When we look at cyclical flows, while we corrected, we got to an overbought condition earlier in the year. We are now at an oversold condition. So we have the value ETF breaking out to a new high from an oversold condition where flows had came out. That's correcting that overbought condition. Now, we talked about financials as one of the key themes in the value camp, one of the key themes in the cyclical or reflation camp. We talked a couple of weeks ago that we had a spike in 3-month lows in the financials, and that generally that marked sort of where a correction might be expected to come to an end. We've seen since then, we came out of this consolidation in the XLF, which is the financials, broad-based financials ETF, came out to the upside, now trading above the 200, 150, 50-day moving average, 21-day moving average, and adding around the 8-day moving average. Within that group, we focused on some of the banks and focused on some of the capital markets dealers. This is the senior loan officers survey, and you can see, I think somebody is unmuted on the line. And you can see that the broker dealers ETF, same thing, came out of this consolidation, the upside, small pullback over the last couple of days. So financials clearly remain a leadership group in the market, clearly look like they've reaccelerated, and certainly a little bit of a sloppy day today, but not something that I don't think should be concerned about. Materials. We talked about the fact that we came out of this consolidation to the upside. Materials continue to lead. And within that, when we look at what's coming out of the infrastructure bill, there is a host of spending that's going to take place over the next 5, 6, 7, 8 years. And certainly this should help the basic materials group, both the miners themselves, copper prices work their way higher in higher lows, and the agriculture stocks this week made a new high. There was a day this week, the only relative strength new high versus the S&P was the agriculture ETF into the agriculture industry, the heavy equipment manufacturers like Deere, the fertilizer producers, and so on. So financials continuing to lead, basic materials continuing to lead. There's the DBA point and figure chart, came off the lows at 1325, pulled back, higher high. Then we had a corrective period from May through July, and then reverse, made a new high and on to a new leg higher. So commodity producers will continue to be, I think, important to focus on. Fundamentally, why is it? Well, during the commodity bear market, companies pulled back on their investment, pulled back on their expenses. And when we look at free cash flow for the commodity producers, we are at multi-year highs, and debt as a percent of their balance sheet is at a relative low. So they're well financed, their debt has come down, cash flow is strong, and prices for the commodities are strong. These are an under-owned group that likely could show great dividend growth. And we saw a giant dividend get paid out of BHP this week. And Rio Tinto just paid a very special large dividend based on their profitability. Moving on to industrials. Last week, we talked about the fact we needed to see the industrials break out of this range, which they did. Certainly that's a positive. It looks like that consolidation is coming to an end. And within the industrials, transports are a group that we always want to watch to see that they are continuing to be strong, because it's an indication of moving goods around the country. And we can see that really since last year, we've been making higher highs, higher lows, and certainly we pulled back a little bit from March. But when we look at the bar chart, pulled back into the moving average and turning their way back higher. Again, nothing broken here. Consolidation looks like it's pretty much done and looks very, very constructive. But where are we seeing some weakness? We're seeing some weakness in the Nasdaq. And we know initially off the low last March, we had a giant move in some of the big Nasdaq stocks. Now, this is the Nasdaq Composite we're looking at. And we're looking at a reading that reads the percent of stocks within the Nasdaq Composite that are in clearly defined upward price trends. In February, 72% of all the were in uptrends. And that came down through March and April and May, and we consolidated and then rallied. But through July, again, we've deterioration in breadth. So now only 42% of all the companies trading in the Nasdaq Composite, which is broad, all companies that trade in the Nasdaq, each given a single vote, tells us that there has been, a lot of damage in the Nasdaq. When we look at the Nasdaq 100, which is dominated by those 5 or 6 really biggest companies, again, when we look at bullish percent, it's come down from 84% of stocks in uptrends to 64% of stocks in uptrends. Not disastrous, but certainly we are seeing some weakening under the surface, and it's something absolutely to keep in mind. Now, I'm going to take a composite of these two things. We've got the S&P here on the top, and we've got a reading of the number of companies making new lows for the year. And when we plot on the bottom NASDAQ lows at S&P 500 all-time highs, which we made yesterday, you can see there are by far more NASDAQ new lows than really at any other time over the last couple of years, while the S&P is making a new high. So divergence taking place in the market. We've made the case that NASDAQ is probably not the perfect place to focus, that it is fairly overowned. There are great companies and there are some great concepts which have done very well for people, but we think that this theme is one that is weakening. So as a good example, this is Kathy Wood's ARK-K, which is her biggest ETF, made up of some of the most innovative companies in the world, made a high in March, pulled back, tried to rally, failed to make a new high, and is now making another lower high, and at risk of really breaking down. It's now below the 150-day moving average, the 200-day moving average, and the 50-day moving average. Something certainly to keep an eye on for those that are focused on some of the really high growth stocks. This is the XBI, which is made up of an equally weighted basket of biotech stocks. Again, biotech has really been under distribution since February. They also tend to be very high multiple stocks. They tend to be hurt by higher rates. And perhaps this is a group, again, under distribution, one that we want to be a little bit careful of. Now, one of the groups that we have had some exposure to is consumer discretionary. It had been consolidating, really had a tough last couple of days. I just make a note that as of yesterday, made a new relative low versus the S&P for the year. You'll see that this is a group that we have been reducing. We've had a smaller weight for the last few weeks, and again, this week, a little bit lower. And that probably wasn't helped by the fact that the Michigan Consumer Sentiment Index printed a new, fresh 2-year low. Other things that are seeing some weakness, energy certainly has been correcting. We broke the 150-day moving average. Relative strength has been working lower. So it's something that we've been focused on reducing. As you know, we use stop losses on positions. As individual positions break down, these are groups that we reduce. Now, on the other hand, outside of the US, Eurozone, after consolidating, broke out back toward highs. Again, this is a more value-driven market. We think that this is one that looks kind of interesting from a valuation perspective. And just to make a point, in a structural bull market, you can't be afraid of making a new high, because when indices start making new highs, they make a lot of new highs. So are people making a point of saying that we have been seeing new all-time highs, and that's true. 2019, 2020, 2021, this is the stock 600 European index. It's a broad-based index, and it's really the first time we've been seeing that since the 1990s, when the bull market came to an end. So it is positive. Yes, we are seeing the market make new highs, but generally once this begins, it goes on for a long time, and we shouldn't be afraid of it. So breadth for Europe and breadth for US, continues to be very strong. And finally, I just want to touch on the MTUM, which is an index made up of high momentum stocks that get recalibrated once a quarter. We recalibrated in May. A lot of value-oriented positions were brought into the MTUM. A lot of big growth stocks were taken out. And again, we saw that break out to the upside over the last few weeks. So it looks to me like, despite the fact that we're in summer, and despite the fact volumes are lower, and despite the fact there are things to worry about, COVID and otherwise, the more leadership-oriented groups continue to be more value, cyclical, reflationary themes. Let's just touch on some data from the week. Lots of people talking about COVID. Certainly the case count is rising. I think this really is more a story of a pandemic in the unvaccinated. We can see the number of cases coming day by day in the unvaccinated community in the ICU. In Canada, 4.3 million people unvaccinated, and full vaccine, 9.5 million people, and virtually no ICU. So certainly we want to watch what's happening in COVID cases, but at this point doesn't look to be something that is significant. We talked last week about the PMI data around the world, broadly above 50, meaning that the data is improving, not deteriorating. And when we look at the wrap up of earnings on the quarter, by far the best quarter we've seen in some time. 75% of companies beating on the earnings estimate and revenues beating almost 78% of the cases. So coming out of the earnings period, pretty strong numbers, pretty decent reactions to some of the earnings, and great numbers in share buybacks that have been brought forward. So we're now back into a period where companies can resume some of their discretionary share buybacks, and that should also be supportive of markets. When we look at credit risk, really nothing to write home about here. This is a spike in spreads that bond investors demanded to cover them off from the corporate risk they were taking to buy bonds back in March of last year. Very benign credit spreads at this point. We watch that weekly to see if there's any major changes. And the volatility readings continue to come down. We've seen a continued lower and lower spikes in volatility. Again, not much to be concerned about here. So we watch every day for signs of weakness. We watch every day to make sure that we continue to be focused in areas of market leadership, and we're very willing to make change. But we do want to be focused. Where we do see change, we do adjust the portfolio weights, we do use our stop losses, we do use our selling strategy, and we're very willing to move on as new leadership emerges. So it's a very, very tactical approach. As we sit, not a lot of change in our financials weight, roughly almost 3 times market weight. We think this is going to be a great source of both earnings growth and dividend growth. Technology is about 50% market weight. Industrials are an overweight and actually have been taken up a little bit as industrials have resumed their move. Our energy weight, we talked about that, has come down. It's been cut by about a half. Disappointing the way that we're seeing some of these behave, and we do still have an overweight position, but it's a much smaller weight than what we had a month ago, and materials we've been taking higher again. When we go down to the other end of the curve, healthcare continues to be very low. Consumer discretionary, what was small weighting, got even smaller. We talked a little bit about that. We have a very low bond weight. We have a very low telecom weight. So a fairly polarized portfolio. Now, before I finish up, I just want to touch on one thing. As many know, we've been working on a second fund which purchases music copyrights. It's a royalty-based fund that pays out to our investors on a monthly basis. I'm very happy to say we've just completed our 4th catalog purchase, and the goal is to buy the very best properties in popular music. As it turns out right now, we have 10 of the top 100 streaming songs in history. One of our songs this week became the longest running Billboard 100 song in history at over 88 weeks. That's blinding late by the weekend. But the artists so far that we've been purchasing copyrights, The Weeknd, Chainsmokers, Drake, Justin Bieber, Camila Cabello, Dua Lipa, Post Malone, very, very well-known songs. Certainly the great thing about buying songwriters credits is that these songs ultimately, if they're great songs, often get recorded again and we get paid again. So having some fun with that, and it's certainly a diversifier to the public market stuff that we're doing, certainly different, and always interested in talking to folks if they want to know more about that. So we know that it's been quite a while since we saw a 5% correction in the S&P, but we also know in bull markets you can get some very long runs. So we don't want to get too focused on that. When weakness comes, if our breadth models turn down, we will get defensive. That is our history. It's what we did in 2000. It's what we did in 2007, 8. It's what we did in 2015, 16. Frankly, it's what we did during the pandemic's decline, where we gave up just about half of what the market gave up. But this is a game of increments. And while we make week-to-week changes, we are not making major wholesale changes right now. We think the hardest thing in a bull market is to stay in your winning positions. And we got a lot of stuff that's working. So with that, Pam, happy to take any questions that might be out there.
Thanks so much, Dave. Well, we had one question this afternoon come through from an investor regarding General Motors. Could you comment on the auto industry specifically? There was some news today as Warren Buffett has sold his position in GM, and we would welcome your feedback and comments on that.
So certainly GM has been weakening. If you want to take a look at the CARS ETF, CARZ, you can see in general, this group has been consolidating really since about February. And we know that there is a shortage of supply. We know that some of the suppliers are having a very hard time with semiconductors. There was some weakness yesterday in Tesla. And certainly, you know, there's weakness in a lot of consumer-related stocks today. On the General Motors itself, so this is a great example of a stock that has led off the lows, but now starting to see some deterioration. These were the lows back in March: higher low, higher low, higher low, higher low, higher low, higher low, making new highs along the way. The first sell signal often is a false one, and it did go on to make a new high. But since then, this is June at $64, a pullback to a lower high, a lower low, lower high, lower low, lower high, lower low. Now we're breaking the long-term uptrend that's been in place since 1450. And so frankly, this is one that I would be more cautious on in the near term. Consumer discretionary, as I showed you, is seeing some weakness. Consumer sentiment is weakening, and this is obviously seeing some technical damage. So from our standpoint, we would certainly look at this first sell signal as one to get our attention. The second sell signal would be one that would be more incline us to go to the sidelines. And certainly at this point, this is today breaking this long-term trend. That's one I would step aside from.
Thanks so much, Dave. Here's another question coming in. XLU, which is, this gentleman says it's a widows and orphans type utilities ETF. It's up around 10% in the last month and has had all-time highs. Why do you think that this is the case?
Well, I think very clearly there are people who are somewhat concerned about Delta. That makes some sense. I think, though, there's also some people concerned about tapering in the bond market. When we look at XLU, certainly the price has been working its way higher. And I'm just trying to launch a separate chart package to see if I can put it up for you. And so the net of it is that, yes, XLU has been rallying. It's on a relative basis, utilities have in general lagged since March of last year. But I think certainly there are some investors, given the time of year, a little bit more cautious, looking to have something that's a little bit more defensive. We have bumped our weight from roughly 3% to 6% utilities. Doesn't look like it's going to come up. And so we do have a little bit more exposure to utilities, but it's in more growth-oriented utilities in general.
Thanks so much, Dave.
I would prefer, as I said earlier, to focus a little bit more on the dividend growth-oriented securities as opposed to the high dividend payers. I think that you'd find that the relative performance looks a little bit better.
Thanks so much, Dave. Just a follow-up question on sentiment. So the University of Michigan's preliminary sentiment index has fallen by 11 points to 70.2, which is the lowest since December 2011. And this investor is wondering why you think that might be the case, and if you're seeing that in other areas, sentiment indexes.
Look, I think that is a consumer sentiment. And certainly we've seen some weakness in consumer discretionary stocks. If you're somebody who's been on government programs are being cut back. Certainly the COVID cases have in the US been an issue, right? Because they just haven't vaccinated enough people. So that's, I think, another contributing factor. I think corporations in general are more optimistic because they are behind in deliveries, and that the inventory levels are relatively low at their customers. But it has caused us, as you could see in our holdings, to step back really only to about a 3% or 2% weight in consumer discretionary, which is more like 12 or 13% of the S&P.
Thanks so much, Dave. We always bring it back to currency. Can you give guidance on how you think the US currency is going to play, and comments on Canadian dollar?
Yeah, so US dollar has been in a consolidation range now for a couple of months. And during that time, Canadian dollars pulled back a little bit. I would take the cue from commodity markets. If commodities remain strong, and it looks to me that it is more likely to do that, then Canadian dollar ultimately, should strengthen over time. But it certainly has pulled back to some degree and consolidated a lot, like the cyclical stocks did from March until July, May until July.
Thanks, Dave. Well, that concludes our questions for today. I will leave you with the final word, Dave, as always. And on behalf of our investors and prospective investors, we thank you very much for providing us with such a good overview today.
Well, thanks, Pam. Yeah, look, it's here we are. We're in the middle of August, and the middle of August can be a bumpy period. Actually, the volatility is remaining very low. Breadth in the U.S. market continues to be pretty solid. We are watching very carefully what's going on in growth stocks. We tend to have a much lower weight in secular growth stocks, as we talked about. We think the risk reward is not quite as good. I think that we just have to keep in mind what the big themes are. If we are going through a generational shift in long-term rates, then dividend growth is a strategy we want to focus in, and it's been very resilient. Certainly, value continues to be under-owned, has consolidated, and certainly at this point is not breaking down in any way. So barring other major changes, that's likely where we're going to stay. But it will take people a long time to break their dependence on large cap tech stocks. And not to say there aren't great companies, but they're well owned and certainly highly priced. And I think risk reward there is not quite as good. So thanks everybody for joining, and we'll reconvene again next Tuesday at 4 o'clock. And look forward to September coming and everybody being back in front of their screens.
Thanks so much,
Thanks,
Dave.
Pam.
Of course. Have a great evening, everyone. Thanks again.